evening and welcome to this call on global equity market views and updates on the positioning of PGIM Jennison Global Equity Opportunities portfolio. While all of us are fairly well aware of why should we be investing into international markets, I have still tried to make a little more sense by some specific comments. And I'm sure a lot of you would have heard this before, but let me repeat. India represents just about 3% of the global world GDP and a little over 3% of market capitalization. Now, when you think of the rest of the 97%, you will realize that while we as investors and specifically in India have been open to looking at products which are single geography or theme, there is close to about 70% of the world GDP which lies outside United States. There is clearly about 40 to 45% of market capitalization which also lies beyond United States. That is a good enough reason to at least scope for opportunities outside. What do we do in this product? We have been investing into a portfolio of 35 to 45 very, very well curated companies. The mandate is to be looking at secular growth ideas only. What do we mean by secular growth? What we mean by secular growth is companies who have a distinct advantage, not only in terms of the marketplace that they're operating, but also in terms of the leadership stance that they have taken in their life cycle. So these are essentially companies which will play like a winner takes it all, as we have been very familiar with that term. And this will be agnostic of any specific geography, any specific theme or sector. So what we are essentially trying to solve for is that this portfolio for an international investor can serve as a single stop shop where not only are you exposed to different geographies, but also to different sectors and themes with just one binding force, which is to buy the highest growth companies existing around the world. Now, while we have been at it, and this portfolio, this product has been existing in the international markets over a decade now, and has had a phenomenal track record, let me make some specific remarks about it. When you think of the stellar track record that the product has had, it has had a Morningstar 5-star rating throughout its presence. It's been among the top 3% of the world large cap performing funds in the globe today. So when you put that into perspective, you have close to about 700 such strategies globally. Within those 700 strategies, this is easily among the top 3% of the performing funds when you look at time frames of 3 years, 5 years and above. Going beyond the credentials, and that is something which is very, very important for us to understand, is that this strategy, which is the flagship strategy for the global growth investing for PGIM Jennison, clearly is managed by a team of about 25 professionals who are dedicated to managing the global growth strategies. 2 of them are lead portfolio managers, Mark Baraboo and Thomas David. We will have Tom today with us presenting. Supported by portfolio specialists or client portfolio managers, and supported by a team of analysts who also double up as portfolio managers for different strategies within the global growth group. Now, while we are at that, let me quickly introduce the speakers for the day. We have Thomas Davis, who we call Tom, and he is the lead portfolio manager along with Mark Baraboo for PGIM Jennison Global Equity Opportunities Fund. We have Douglas Richardson, who is the managing director and client portfolio managers, who helps Tom and Mark communicate with clients and also be a bridge between the analysts as well as the portfolio managers, as well as clients like me and you. Now, on that note, and before handing over, I am fully well aware that Tom and Doug will go through prepared remarks over the next 25 to 30 minutes.
Thank you, Abhishek, and good evening, everyone. For today's presentation, I will speak for roughly 5 minutes and share our perspectives on the markets in the fourth quarter and full year of 2021. I will then turn the presentation over to Tom Davis, one of the 2 portfolio managers on the global equity strategy. Tom will discuss the secular trends present in the market today and the investment opportunities that these trends do offer. He will then review the portfolio's performance for the fourth quarter and full year and discuss the current environment. 2021 was a year in which markets were shifty with periods of rotation across growth and value, emerging markets and developed markets, large cap versus small cap, high quality versus low quality, responding to several concerns around COVID, inflation, central bank policy, political dysfunction, and supply chain bottlenecks. You name it, there was a lot going on in 2021, and it has spilled over into 2022. Despite this, the US markets held up remarkably well, with the S&P up 27% last year. However, the winners and losers for this year were different in 2021 than they have been in quite a while. Energy and financial sectors, traditional value sectors, were among the strongest, along with technology stocks, which were supported by the strength among the mega cap companies. On the other hand, consumer discretionary stocks in aggregate were among the weakest last year. Non-US markets, as represented by the MSCI ACWI ex-US, were up a little over 5% last year, driven by semiconductor-related industries, banks, oil and gas, and luxury goods companies. This was offset by pressure in internet, interactive media, and entertainment companies. Emerging markets were down approximately 5%, caused primarily by the performance of China, where we have eliminated our exposure. Interactive media, internet-oriented companies and software were the largest detractors. Again, this was offset by strength in energy, in banks, oil and gas, and semiconductor-related industries. So as you can see, some of these themes carried across various markets, but with varying degrees of impact. You can see the sector performance reflected in the yellow bars for the full year of 2021 for the global ACWI benchmark, with strength in energy and financials, followed by technology. Again, this was offset by consumer discretionary at the other end of the spectrum. The blue bars reflect Q4 performance and just show how variable the quarter's performance was versus the full year of 2021. In Q4, communication service was the largest detractor, impacted the most by internet-oriented stocks. The graph, which we have displayed before, is just a good reminder of where equity returns are generated. The graph shows how powerful earnings growth has historically been as a driver of returns over rolling 5-year periods going back to 1997, which includes the tech bubble of 2000 and the global financial crisis of 2008. The top quintile is where you find the big growers, and the second quintile typically contains double-digit growers, which are very difficult to find in the market today. This understanding has been important to our portfolio composition, the focused work of our analysts, and ultimately, the very strong track record for the strategy. At the end of the day, if you are focusing on the top 2 quintiles of growth, you have a better chance of winning over time, irrespective of the macro environment. And it's a great reminder of why we invest in this area. Interestingly, though, in 2021, earnings growth quintile 1 was the weakest performing quintile across the ACWI benchmark. So occasionally this dynamic does not hold up, but over the long term, this relationship has held up. With that being said, we believe unique, differentiated products and services, especially those that reflect new technologies in response to the changing needs of customers, will always remain in high demand over time. In the context of rolling 5-year periods, we expect 2021 will ultimately reflect a modest impact on this relationship, but not a wholesale change in the long-term trend. We are showing the scarcity of growth and how companies with 15+% sales growth over 5 years have been declining from a high of around 50% in the 2007-2008 time period. There has been a slight uptick over towards 30% over the past few years, but now with the Federal Reserve and other major central banks around the world starting to raise rates to slow economic growth, this trend may once again head lower. We know from experience over time, as their growth is sustained, while much of the market around them decelerates. This is a good environment for long duration secular growth companies. I will now turn it over to Tom, who will begin his presentation by discussing the secular trends that we continue to see in the market today.
Thanks, Doug. I'd add my welcome as well. Good evening, and thanks for joining us. I want to refocus our attention on slide 7 on parts of the market that have really stood out during the COVID pandemic and have been one of the key sources of return for the portfolio. Many of the trends highlighted here were underway pre-COVID, as the digitalization of the world around consumers enabling direct business models date back anywhere from 5 to 8, even 10 years in some cases. But the growing presence and use of cloud-based application software was permeating into the enterprise in more recent years as technology capabilities evolved. COVID certainly accelerated these trends dramatically, though, over the past couple of years as consumers stayed home more, limited their physical shopping, sought at-home and fitness opportunities, even relationships through online dating apps. On the business side, companies scrambled to enable work from home environments with seamless communication, document collaboration, cybersecurity, and reliable underlying systems capabilities. These trends are by no means about to go away. They are entrenched, they are continuing to evolve, and they will ultimately drive a lot of growth going forward. People all over the world have used these capabilities and technologies to adapt their personal lives as well as their jobs to new routines and ways of living. And in many cases, this brought about significant improvements in both productivity and efficiency. So even with the adoption to date, though, penetration rates in many of these themes remain well below 50%. So plenty of growth, plenty of opportunity still to come in the next few years and beyond. One of the keys to thinking about these trends is to recognize that the broader impact of accelerating technological innovation is incredible. We live today in the midst of one of the most significant periods of innovation in a generation. And it's still very, very early days, in our opinion. These trends will continue to evolve and emerge in the coming quarters and years. And things like electrification of vehicles and transportation, autonomy in some of these vehicles, smart homes powered by sustainable energy, virtual work environments, and even a metaverse that'll blend physical aspects of our lives with digital aspects of our lives in a seamless fashion will increasingly become part of our everyday lives, as well as great investment opportunities. And it's these types of things that our analysts and Mark and I as portfolio managers spend our days thinking about and investigating and working into the portfolio. In the short run, we're now living through a period of normalization from the pandemic-induced surge in demand over a relatively short period of time. There is also some consolidation and weeding out of business models and technologies as we find new, more sustainable levels of growth going forward. Not everything that we or many other investors around the world, for that matter, invest in has played out exactly as expected. There's very often a few kinks in the road here and there, and this is to be expected. Other companies have seen valuations surge with growth in sales and earnings and are now going through some re-rating as those rates of growth renormalize and settle out a bit. Where investment theses have not delivered on expectations, where earnings have disappointed, or where valuations have not been supported by sustained growth, we've certainly taken action and we will continue to take action if necessary. Nonetheless, looking at 2021, as Doug alluded to, has proved to be a challenge for us from a performance standpoint. While the portfolio was up in absolute terms, it did underperform the benchmark, the MSCI All Country World Index. Especially frustrating to us and not easily seen in this performance table was the fact that we actually managed to bring the portfolio back to break even and in line with that benchmark as recently as mid-November. So the last 6 weeks of 2021 saw a sharp downturn in growth stocks. And to be candid, the pressures have continued into the first few days of 2022. I would stress that this is not the first period of pressure we've experienced as portfolio managers. And it certainly won't be the last. While the fund has been offered in India over the last several years, the Global Equity Opportunity Strategy actually goes back to 2011 when the team joined Jennison and PGIM. And Mark and I have actually managed global strategies dating back all the way to 2004 when we created one at our previous firm. So over the years, we've seen and experienced changes in central bank policy, much like we're seeing today. The global financial crisis, we've lived through several different Chinese growth scares in various iterations, political referendums and election outcomes that weren't necessarily anticipated going into them. And of course, the last few years, we've seen the pandemic. In 17 full calendar years of managing global strategies, we've underperformed in less than a third of them. So we feel very strongly that our approach, our focus on structural growth, our portfolio construction methodologies, and our focused construction do, in the long run, reward investors very significantly. Typically, in these periods of stress, stocks that had been some of our best performers in previous periods become some of our worst or most pressured positions. And yet, because very little has actually changed fundamentally, in many cases, their strong fundamental business prospects return them to performance leadership in the following periods and years to come. How the current environment will evolve obviously remains to be seen, but I am and continue to be very confident that there will be great business opportunities for us to invest in going forward, just as there has been in the past. Digging into 2021 a little further, and the fourth quarter as well, you can see that our key exposures in technology, communication services, and consumer discretionary were the sources of our underperformance. And in fact, by Q4, though, it was really just technology and communication services, as the consumer discretionary performance snapped back. Our underweights, and in some cases, lack of exposure in other sectors, really had no material impact, giving a little bit of a put here, a take there, but net really didn't impact the bottom line. In the case of technology, positions in DocuSign, the leading electronic signature company, Square, which is now known as Block, just due to a recent name change, the fintech company that's helping very small merchants and underserved consumers gain access to financial products and services, and Adyen, a leading digitally native payment processing company that we've owned very successfully since its IPO in 2018, were among our largest detractors. These positions overwhelmed solid returns in larger cap companies such as NVIDIA, ASML, and Apple. DocuSign and Square developed concerns about earnings strength over the next couple of quarters and have since been eliminated from the portfolio. Adyen, though, remains in the portfolio as it continues to grow its processing presence in major global markets. It has been building out its point-of-sale physical capabilities among payments to complement its digitally native online presence in order to offer customers seamless omni-channel payment capabilities. And perhaps most importantly, it's extremely profitable, with EBITDA margins approaching 70%. In the communication services, positions in Sea Limited, owner of the most downloaded game in the world, Free Fire, as well as its leading e-commerce platform across ASEAN ex-China, and Snap, the owner of the Snapchat app, both were under pressure. Sea due to a plateauing in gaming revenue, and Snap due to slower advertising revenue. Snap was sold as we believed that the advertising environment would be a bit more challenging and under stress for the near to medium term. New online privacy measures that have been enacted in recent periods make it more difficult to target consumers directly, and hence the value of advertising is a little more murky at the moment and needs to be refined and reinvigorated. This puts earnings estimates at risk over the medium term, and so as a result, as I said before, we've taken the name out of the portfolio. In the consumer discretionary sector, it was really a tale of two outcomes. Mercado Libre, the leading e-commerce and fintech platform across Latin America, really proved to be a bit of a challenge all year long. Although we continue to believe it remains the best positioned provider of services in both of these areas going forward. That said, very strong performance and operating results in our largest portfolio position, Tesla, and which is, by the way, another position that we've owned since the portfolio inception at Jennison, helped to drive very solid stock performance overall. The other area of broad strength in consumer discretionary was in our luxury brand positions. I've talked about how companies offering technological innovation to drive rapid adoption and market share gains from incumbents are a key element of our strategy and portfolios. Another key piece to the approach and our portfolio exposure lies in companies that are extremely unique, rare, very hard to replicate. And luxury brands fit this description to a T, because it just takes years to build a reputation and customer acceptance as a very unique product offering. Our holdings in LVMH, Ferrari, Richemont, and Hermes all helped support the contribution from consumer discretionary exposure, especially in the second half of 2021 as their sales and earnings accelerated. In this slide, you can see the majority of our underperformance came from North America, in addition to DocuSign, Square, and Snap. Other detractors over the course of the year included RingCentral in communication software, and Peloton, the exercise bike and connected fitness company, as well as a lack of any ownership and exposure to Microsoft, which as a large cap did well. RingCentral and Peloton were eliminated from the portfolio over the course of the first half of the year. Our sector exposures have long been tilted towards consumer-facing products and services across discretionary, staples, and communication services. And even our technology positions, in many cases, have some element of consumer exposure. This reflects the breadth of creative, differentiated, and often innovative opportunities available with great growth prospects in these areas. On the other end of the spectrum, we have had little to no exposure in things like traditional financials, energy, materials, utilities, and real estate. None of these areas offer particularly significant and meaningfully differentiated opportunities for innovation and growth, nor do they have a lot of pricing power at the company level. Other than to say that regional exposure is a residual of our process, not an input. We're usually underweight developed Asia Pac, as there are relatively few innovative and rapidly growing opportunities there. And the European, emerging markets, and North American exposure can ebb and flow depending on the underlying opportunities that our analysts can identify and present to us for discussion and consideration. I would just note the emerging markets today is currently a bit below our normal range, but reflects our pullback from direct China exposure over the past year, as Doug alluded to a few minutes ago. On this last slide, on slide 15, let me just touch on some of the characteristics. There we go, Doug, thanks. We've tended to skew larger cap and continue to be positioned that way today. In recent years, a number of the larger caps have been excellent performers as their technologies have allowed for rapid growth in customers, and their scale and network effects only contributed to even greater growth along the way. Today, the breadth of their businesses and massive cash flows that they're using to reinvest in those businesses, along with multiple sources of revenue contribution, are allowing these companies to really even enhance their considerable positions and power further growth. We are watching certain efforts to further regulate, or in some cases, suggestions to potentially break up some of these companies. But frankly, outside of China, we think that these efforts are likely a long way off. Will take a long time to analyze, study, and develop proposals. And in the meantime, we think they'll continue to be very powerful growth engines. The other observation I would make is around valuation. On the surface, the portfolio may look expensive. However, I would note that many of our high quality companies have generated very fast growth and improving profitability over time. Technology has allowed for greater customer reach, structurally higher margins, and stronger returns on capital than companies of past decades. Furthermore, many of these companies have been investing in their growth through their P&L, incurring elevated expenses to hire salespeople and engineering talent. And so in the shorter term, this has depressed earnings power, even as it funds and develops and supports future growth. In the current environment, with rates set to rise, we've been reassessing each individual holding over the past 4 to 6 months with an eye towards profitability and durability of earnings expectations. Higher rates won't have a major impact on the financial strength of our holdings, as none carry particularly high levels of leverage. However, higher rates do impact the discount rate used by investors in considering valuation, especially for companies with earnings and cash flows that accrue further into the future. So we've already reduced our software exposure by about 2/3 over the course of Q4. And we've been reallocating into other positions with greater prospects for nearer-term earnings power and durability, even in the face of slowing global economic growth. As the expected pace of rate hikes has accelerated in recent weeks, we've been faced with a challenging debate internally over portfolio positioning with an eye towards rates against what we expect to be very solid earnings reports and outlooks coming in the weeks ahead, really beginning later this week and early next week, and then extending through February as we work through the earnings season. We expect strong earnings and solid outlooks to remind investors that high quality companies With market-leading products and services, we'll continue to see solid customer demand regardless of the broader environment. I like to remind folks that even in the depths of 2008, the lines stretched around the block for the Apple Store as people queued up looking to buy the Apple iPhone. We also expect more cyclical or value-oriented companies to begin feeling greater pressure from slowing growth trends brought on by higher rates over the next 6 to 9 months, maybe even sooner. Financials may well see less demand for credit and higher credit costs as some of their borrowers begin to feel pressured from higher rates. Oil and gas demand may begin to decline as higher prices begin to pinch consumer travel plans. And many aspects of the global industrial sector are tied to economic growth as well, which should begin to decelerate as rates move higher. Given the choice, and despite some of the shorter term volatility, we believe that remaining aligned with forward-looking opportunities, driven by the latest innovations, will continue to reward investors over time. It's served us well in the past, and we continue to seek these today and expect to be looking at these same opportunity sets, same characteristics going forward. And as Doug highlighted, over rolling periods of time, some of those highest growers often end up being the best performers. So with those comments, let me stop here and let's open it up to Q&A. And my experience over the last few weeks is that audiences such as yours have a lot of questions, a lot of great questions. So I'd much prefer to allocate time to hearing your questions and trying to answer them. Thank you.
Thank you, Tom and Doug, for those descriptive comments and prepared remarks. What I will do is, while there are Q&A lining up in the live Q&A box, we have over the past few weeks, while we announced the call, really made sure that we collect the most critical questions. And I've tried to put them together. It is helpful for all our audience participants to be able to make sense of what we are doing here in the portfolios. So allow me to go with the first one, which goes like that. While there is heightened amount of market volatility, can you in specific discuss the outlook for some of the top holdings and where are you seeing incremental opportunities? Sure.
Well, let me start by focusing on our number one top holding, that of Tesla. I referred to it in my remarks, but let me be more specific. Tesla is by far the leading leading global player in the transition to electric mobility, electric vehicles. They have built a phenomenal business, a phenomenal company, headquartered out in Silicon Valley, more recently having moved to Texas, but obviously an awful lot of the talent and engineering and innovation coming out of Silicon Valley. Last year, 2021, they produced and delivered just over 900,000 vehicles. This year, they are expected to produce and deliver somewhere closer to 1.4 million, so close to a 40 to 50% increase. They have been, their original plant in Fremont was added to with the facility in Shanghai, which continues to be expanded even as we speak. They have a plant in Berlin coming online as we speak, or certainly in the next few months. And they have a very large plant in Austin, Texas, which will also be coming online. So these will support the continued growth in unit volume. And the expectation is that Shanghai and Austin in particular, and perhaps even Berlin, have room to further expand capacity in the coming years as it moves towards 2 million plus vehicles. So very, very solid demand out there. Interestingly, and you may not be aware of this fact, but Tesla has yet to spend a dime on actual marketing. Its success to date over the last 10 years has been entirely through word of mouth, through owners sharing their experiences with others, and with people observing and ultimately trying to test drive the cars. So incredible demand for a company that's been a leader in this space and has left the entire traditional and historical automotive industry globally trying to catch it with marginal success. There are more and more electric brands being launched today, but to date, none of them, and I emphasize none of them, have been able to meet the same specifications, either in range, in size and capabilities that Tesla offers today. There are some brands out there on the verge of coming to market in very small numbers that are perhaps getting closer, but we'll see. In the meantime, Tesla's got years of experience in dominating this space. The profitability has also dramatically improved over time as the scale has risen. And then the last thing I would highlight is that they're building, at least on the automotive side, they're building a recurring revenue stream. Today, if a customer wants real-time navigation and traffic information, wants to be able to connect to a cellular network and stream their playlists over Spotify in the car, there's a $10 a month recurring revenue stream for the company. Going forward, they will monetize their increasingly automated driving capabilities with a monthly subscription. And then that's before we even start talking about the energy business. Tesla has a growing energy business, industrial scale energy business with grids, selling battery packs and battery energy storage to utility operators. And it also has a growing residential solar and storage business here in the US. They claim that at some point over time, they think that the energy and solar business could be as big or almost as big as the automotive business. And yet today, it barely gets mentioned and is really not in very many analyses for valuation. So huge opportunities, despite the success that it's had to date. And as a result, that's why it remains a very large position in our portfolio. If I look at some of the others, Apple and NVIDIA, I mentioned were solid performers this past year. Apple continues to build not only great product, but also has a booming services business. And the services contribution today to Apple in terms of storage fees, in terms of subscriptions, the App Store, Apple Wallet, Apple Play, Apple Movies and the like, is continuing to grow significant amounts of cash flow generation and helping support growth. So great opportunities still to go for Apple. NVIDIA obviously is one of the leading chip companies. Obviously got its history and got its reputation in the gaming space with market-leading GPUs. Has moved into the data centers with very high performance compute power and servers, is involved in autonomous driving with the GPU chips helping to manage and run these vehicles and internalize and analyze the data in real time. So, again, leader in its space, probably multiple years head start relative to just about anyone else out there. So again, big position for us. In our top 10, we have LVMH and Hermes, both of them. Luxury plays that I alluded to, very strong demand, somewhat insulated from the economic swings out there across the globe. For the most part, consumers who are able to buy luxury goods and have the disposable income to buy luxury goods are less sensitive to the day-to-day, month-to-month, quarter-to-quarter impacts being created both by things like pandemic, but also by somewhat higher rate environments. So those are some of our top 10, some of the rationales underlying them. You can get the feel, the sense of some of the secular trends driving them, the technology behind them that gives them the advantage over many of their competitors. Really dynamic opportunities.
Sure. Thanks, Tom. Thanks for that. The second question, and I know some part of this you have already addressed in your prepared remarks, but just for the benefit of the broader audience, let me repeat that question. In a high inflationary environment, how does the fund positioning of a secular growth portfolio gets affected? And are you still seeing incremental opportunities which you can scope going forward?
Yeah, so let me answer the second part, the latter part. Yes, there are opportunities going forward. And there always will be, thanks to technology and innovation and changing consumer tastes. So that's the good news. And that's been the case, in every episode of market rotation, regardless of what the underlying source of that rotation is. With the higher rate environment, we do certainly give increased consideration to the timing of cash flows, the timing of earning streams, the question of profitability and whether companies are profitable today or whether we need to, wait some period of time out into the future. The longer we have to look into the future, the more difficult it gets because of that rising discount rate, obviously, and the impact it has as you discount the future back to today. So as a result, we have certainly really over the course of 2021 and especially the second half and the fourth quarter, increasingly focused and looked at and revisited the question of what does the earnings stream look like? How much earnings growth is achievable today, tomorrow, and the next couple of years? And we've been, as part of the effort to reduce sensitivity to those future earning streams or companies that are not profitable today, but that need another 2 or 3 or 4 years before becoming profitable, the exposure there has come down. I did mention we've taken our software exposure, some of those SaaS companies that helped us pretty considerably in later part of 2020, early 2021. We've cut that back by about 2/3 at this point, and replaced it or shifted that exposure over to companies that have solid near-term earnings prospects, strong growth prospects in this year and next, and so forth. We are trying to retain though the look and feel of the portfolio. It will continue to be a growth-oriented fund focused on secular growth and innovation. We're not going to change our stripes. That's generally never a very good thing for a manager to do because our strength, our expertise lie in the identification of these kinds of growth opportunities and secular growth and high quality growth. But we are sensitive to the fact that rates are likely rising, and at least for a period of time, the focus will be on stronger earnings power sooner.
Sure. Now, Tom, that clarifies a lot. And just in continuation with this earlier question that I had, I want to have a follow-on question, which is that intuitively, when you think of it, technology should have been least affected by interest rates, but due to the nature of high growth, and maybe in many cases the market assumes that we are running portfolios which are extremely high on valuations and too much back-endedness in terms of the growth that will come through. Are we scoping companies outside the technology sector? Is that the stance are we taking? Are we seeing profits visible in the near future? So, what are your views on this observation, and how are you putting the portfolio stance going?
Well, it's obviously a multifaceted question. A few different things going on. There are technology companies that are more consumer-facing than enterprise, and I think consumer spending in general is more durable, is less sensitive to annual budgets that a business or an enterprise might have. The consumer needs for goods, both discretionary but importantly, staples as well, continue to move forward. And so technologies that are focused on helping the consumer economy should continue to do quite well. But then again, even on the enterprise side, with this digitalization of the global economy that we are in the midst of, corporations recognize the need to spend on leading products to help with everything from cybersecurity to business collaboration to communication. And so it's not as though these companies are going to, suddenly face a cliff and see earnings dry up. In the meantime, some of them are slowing their hiring. Some of them are, which will help accelerate some of their underlying earnings. As I said before, some of the near-term earnings pressure or under-earning is a result of the fact that they are investing through their P&L in the business with salespeople or engineers. It's possible some of that decelerates a bit and allows more earnings to come through. So that'll help offset some of the concerns created by the discount rate. I'd also emphasize, though, that the levels of leverage in many technology companies and consumer companies, for that matter, are not particularly high. So the financial impact of higher rates is really not the concern here. It's really just the rates being used for valuation. And I feel like there was another piece to your question, and I've let it slip. Was there one other element here?
No, Tom. I think what we were essentially trying to understand more is that, do you see profits coming through even in the medium term, or is it more ended in nature? I think you have.
Well, and we're, this earnings season that's about to kick off is going to be very instructive and very informative. We'll see exactly how companies are thinking about the rate environment themselves, and we'll hear, from their management teams how they expect the first half of 2022 and beyond to look. The other thing that may help offset some of this, is the issue around supply chains. Part of the issue at the moment, not the only issue clearly, but part of the issue at the moment has been the massive disruption globally in supply chains, which have caused shortages, which have helped push up prices, and which have contributed, or at least are one element of the inflationary pressure we see today. And so as some of those supply chains get worked out, as manufacturing comes back online, store shelves begin to have product again in much greater quantities, some of those pressures will diminish. One element of inflation will diminish, but at the same time, there'll be more product available for consumers to purchase, which will help the bottom line of many companies as well, especially on the consumer side. The one caveat, and there may be a question that you can get to on this, but I may preempt it, but the one caveat here is I think about risks, honestly, is COVID. What variants, whether it be Omicron or otherwise, could still come at us and especially affect many of the emerging markets where there are key elements of production and supply chains that that could be at risk of further disruption, and if that happens, that sort of upsets the model for global recovery, at least from a supply chain standpoint. So that's a risk we continue to monitor, as one consideration. Sure. Thanks,
Tom. I'm sure that the risk question is very, very pertinent, and it has popped up in the Q&A box already. Now, moving on to the next question, is that while in our commentaries over this quarter, as well as a little bit in the beginning of the last calendar year, we have clearly maintained that sometimes there could be detractions in performance going to specific stocks and specific sectors. In that light, can you talk about our research focus? What is our buy and sell discipline? What will induce any kind of actions in the portfolio?
Yeah, sure. So let me start with the buy. We'll move to the sell, and we'll hit the resulting actions. We focus a lot on customer demand. Who and what are buying? What kind of products and services are being purchased, both on the consumer side by individuals or on the enterprise side by companies? What products or services are being displaced? So is this a new technology or a new capability that is a significant improvement versus the old? In which case, the magnitude of that growth opportunity could be massive as an incumbent industry or incumbent product set or service is being replaced in many cases on a global basis. So we focus on that top line opportunity, the sales opportunity. The question that then follows from that is, what's the profitability look like? What's the cash flow generation look like? And how quickly can the earnings ramp up? How quickly can profitability improve? And the last piece of this is this product something that's fairly unique, defensible, could be a market leader for an extended period of time? So it's a focus on those types of characteristics that we really spend a lot of time thinking about. Because our objective, all else equal, our objective would be to go into a position thinking that we're going to own this thing for at least 3 years, hopefully much longer. As I alluded to, our positions in Adyen go back to the IPO in 2018. Our position in Tesla goes back actually, to when we set up the portfolio at Jennison, and actually we owned Tesla in our prior firm too, back at the IPO. So hopefully we're going to own these things for a very long time, but we think of them, at least on the inbound, as something that we would want to own for at least the next three plus years. So it has to be pretty unique, has to be a market leader, has to be something that is very hard to replicate or create or requires a very long time in the case of those luxury brands to build the kind of reputation to quote unquote qualify as a luxury brand. On the sell side, we feel in most scenarios like we have a pretty good process that frankly is a competitive edge for us. To the extent that there is a competitive concern that begins to arise, we're going to move on. We want to be the market leader, but we want that growth to be durable and significant. And if there's a new competitor emerging into the marketplace that's going to start to question that, then we need to be cutting back our position sizes and eventually eliminating it altogether and moving on. The other thing that will trigger a relatively rapid, a very rapid sale is if there is, something at the management level, or certainly at the financial and accounting level, that starts to pose red flags or concern. We do not want to be in situations where there are, questions around the proprietary of accounting, questions around the integrity of management. Those are not good situations to be in. And so we hope we've done the correct due diligence on the way in to ensure that those don't exist. But sometimes things arise that just weren't visible to anybody previously. And so we'll be very, very quick to move out of those situations. The only other thing that involves the sell discipline would be the adding and subtracting of position sizes. If earnings are exceptionally strong, if the investment thesis keeps being supported and improved upon, we'll likely increase the position size. If a company sees its stock price appreciate very significantly over very short periods of time, 3 to 6 months, and nothing's really changed from a fundamental standpoint, we'll take the opportunity to trim the position back. And because we have portfolio size, or because of our portfolio at only 35 to 40 positions, some of those positions can be quite large, as you can see from our top 10. Taking 50 to 100 basis points out of a position that's done exceptionally well over a very short period of time is very easy for us to do and to lock in some of that profit and gain. Then, when a market rotation comes along or a drawdown comes along, it also gives us room in some instances to add back to some of our strongest or highest conviction names as well, hopefully at a lower price. So there's some ebb and flow in the portfolio around that dynamic. But that's really the sell discipline and the different aspects of the sell discipline that come into play. The last piece. So how does that translate into actions? Well, in the environment such as we're in today, we've started to place, as I said, over the second half of 2021, we've placed increased emphasis on ensuring nearer term earning streams, profitability, and cash flows, recognizing the valuation component, or impact from a higher rate. Is it going to protect us completely? No. At the end of the day, we are still focused on growth investing and growth opportunities. And there can be perceptions in the marketplace, at least over the short term, that may not actually bear out, but that nonetheless are oftentimes knee-jerk reactions by many in the investment community. And interestingly, just in the last few weeks, we've seen not only the higher growth companies come under pressure, but we've even seen some of the stable growers that had previously held up pretty well start to come in for profit taking. Companies like Alcon in contact lens, eye care, as well as ophthalmic surgery tools, has come under significant pressure, and yet it's a very stable business. The nature of eye care does not change, whether we're in a roaring growth environment or a recession, nor higher rates nor lower rates. People, if you can't see, you need to take care of it. You need to find a solution either through contact lenses or glasses or surgery, and yet even a company like that has come under pressure. So we're trying not to make changes there because we feel it's unwarranted. But we do certainly recognize the environment we're in and are placing more weight, more emphasis, both in the work the analysts are doing, in the valuation work, and considering our sell discipline around profitability sooner rather than later.
Sure, Tom. Sure. That kind of explains. And I think what we have covered till now is obviously our discipline around buy and sell, the biggest risks that you see, how have we changed our portfolio stance with that in mind, or where we have not, because we clearly see that the strength of the business continues. Now, moving on, there is a very interesting question, and though I understand that we don't manage our portfolio from a global macro backdrop perspective, the question goes on the pretext of, in a hiking rate cycle, United States has always outperformed, while we are maintaining a lower exposure to developed North America. Now, how do you what's your thought around that?
So my first comment would be, well, my first couple comments would be, I agree with your opening comment there. We're not macro investors. We're very much focused on company by company analysis and portfolio construction. And I could invite both a macro strategist or even an equity strategist into my office from just about every capital markets firm on the street and from around the world, and everybody would have a somewhat different opinion and outlook, probably all of which would sound incredibly reasonable and very well articulated. And yet I would be left, basically tied up in knots like a pretzel, because trying to make heads or tail of one versus another becomes an almost impossible task. So that's why we spent so much of our efforts to focus on the companies and the company fundamentals, rather than getting too caught up by trying to take a particular macro view and then drive the portfolio from there. The observation that the US typically outperforms in a rate cycle is an interesting one. But I think, and I suppose a lot of that really stems from the fact that what happens in the US then ripples out, and especially into the emerging markets. We're not trying to make a particularly big bet on any country or any region. Our US exposure is a little under weight. It's been above weight at different times in our history as well. Interestingly, the European weight typically ends up somewhere in the mid 20s. Sometimes it's a little above bench, sometimes a little below. The bigger swings, though, really are within emerging markets and the North American exposure, mostly US. With emerging markets more recently having come down because of our decision to move out of China, that has skewed some of the weight allocations. So Europe has actually bumped up a little higher than perhaps we would have otherwise, thanks to that luxury brand exposure. And the other issue with the North American exposure at the moment, of course, is that North America has one of the most robust technology sectors. You just can't find another Silicon Valley anywhere else in the world, or the equivalent of Silicon Valley anywhere else in the world. And so as a result of some of that repositioning I talked about earlier, taking down some of our software exposure, reducing some of the exposure to companies that had longer duration earnings and free cash flow outlooks, that also has had the net effect of bringing down our North American exposure. And so, again, none of this is being driven or dictated intentionally or consciously from a macro standpoint. But again, looking at where we're finding the opportunities, the dynamics and characteristics of the businesses in different regions are leading to some of these geographic exposures more than anything else.
Sure. Thanks, Tom. That clarifies. Before moving on to the next question, let me make a quick announcement for the audience. We have another about 5 minutes to go before closing the call. What I'm trying to do is with a plethora of questions that are coming in, I'm trying to get the most broadest of questions which the larger audience can identify with. But having said that, any questions which are in specific asking for a data point, be rest assured that the sales team or me directly will be reaching out and making sure that we will answer that. Just in case we miss any, make sure that you reach out to your PGIM representative to get that answer. We'll make sure that we have all the answers. If not, we'll make sure that we reach out to Tom and Doug and get those answers for you. On that note, let me quickly move on. And I think we have talked quite a bit about the portfolio stance, risks. We have talked about North America with an aspect to how it performs from a rate perspective. Essentially, there's a very direct question of trying to estimate from us that what do you think are the earning estimates going into 23 and 24 for the portfolios?
That's a great question. And my answer is probably not going to be all that satisfactory, because we don't actually aggregate up the earnings estimates, like an index to have a view. I think the way to answer it, again, coming at it more from the way we think about the world and the portfolio, would be in looking at earnings expectations company by company. What do those ranges look like? How do they compare, say, to the last year or to the last several years? And it's going to relate to several buckets. So the luxury brands, of which we have a decent exposure, have seen accelerating revenues and earnings trends over the last, ever since the bottom of the pandemic. But that has continued to accelerate and now exceed 2019 levels quite noticeably as we cross through the second half of 2021. Very, very strong trends are continue to emerge in China and North America, and Europe's been coming back. And that, by the way, is happening before we even really get back to a more traditional environment for tourist travel. Very few tourists from Asia are traveling to Europe these days. And so the sales opportunities in duty free and the tourist capitals of Europe, are not back to where they once were from a luxury sales perspective. And yet we're seeing very strong results. So we're actually seeing accelerating trends there that continue to be in the high teens, and even in some cases into the low 20s. That will probably start to normalize though over time, back down into the low double-digit range. But at the moment, we're still seeing elevated trends. I think some of the more consumer-facing e-commerce trends will continue to be quite robust. I mean, I know, many of my friends, many of my family members continue to order things online at a pace similar to what we saw during the pandemic, which was higher than it was pre-pandemic. While the exceptional growth of 2020, when everyone was really in either mandated or at least self-imposed lockdown mode, may have been an aberration or exaggeration, I think that the growth rates, on the consumer side will continue to be quite robust. The technology side, the enterprise side may normalize down a bit, especially with higher rates as we think about, as companies think about budgeting and positioning, and how does that impact the P&L? Are they going to hire as many people as they previously did? That may see a little more normalization. That's also, again, partly why we've been shifting some of that exposure out of the software stocks. Doug just helped me out here and quickly ran the data. Our fact set would suggest the long-term EPS still ought to be for the portfolio somewhere in the 20 to 25% range, kind of on an embedded basis. So still very, very solid growth prospects looking forward. And of course, that will ebb or flow depending on how the construction evolves over time.
Wonderful. That looks interesting. I do want to bring out here that when you look at the sell side estimates, the consolidated numbers look something like a 33% CAGR EPS growth over the next 3 to 5 years. So bringing both of them together, even if we are somewhere between 25 and 33, I think it's a good outcome to be at, Tom and Doug. But
I think better to be a little conservative and then be proved wrong to the upside. That stocks will work much better if you are conservative in your view, and then you have positive surprises. Stocks don't work so well with negative surprises.
Yes, very much, very much. So I'm conscious that we are overshooting time, but there's one very, very interesting question, the last one that I would want to ask. And as I promised the audience, rest of it will surely be answered one-on-one through emails, through phone calls, webinars, whatever is required. The last question is more so to be asking that when you think of some large companies in let's say the US market, Goldman Sachs for that matter, I think the Q4 profits were down dramatically by 13 to 14%. Do you think that implies that the cyclical rally or the value economy that was picking up is kind of flattening out and going back to the negative? And are there early signs of that supporting money flowing back into growth?
So I do think that these are, JP Morgan had the same situation. I do think these are indications that that the growth is not open-ended for the value and cyclical names out there. That they will see growing pressure. on their earnings, and not to mention, from higher rates, but just from the year-over-year comps as well, because they had a pretty good year in 2021 because 2020 was so dismal for many of them. And now that we're moving into 2022, the comparisons won't be as easy. So I think, that's partly why I highlighted the fact that, these cyclicals are going to be subject to broader underlying economic growth trends. And if the central banks around the world are focused on raising rates to slow economic growth and try to put a damper on inflationary pressures, they'll be impacted as well. So the cyclicals will not be immune. And at the end of the day, then it becomes a question of relative earnings growth strength. Who's going to have stronger relative earnings, out there as we go through this environment? Will the cyclicals, which typically probably have been growing in the single-digit range, maybe a little above global GDP, depending on the industry or set of companies, in many cases probably closer to global GDP. As global GDP is reined in and slows down, those growth rates are going to look all the less impressive. And even if some of the higher growth names see some moderation, you're still going to have much more strong relative strength in earnings, as we move through this environment. And in our opinion, at the end of the day, investors really want to focus on relative earnings strength. And that's where, again, the technology, the consumer-facing, the high-demand kind of companies ultimately reside.
Wonderful, wonderful. Thank you, Tom. While I said this is the last one, there is another very compelling question which I don't want to let go. So this is surely the last one, but it is more to be asking us on what is our risk management discipline, and this is asked in light of some specific stocks like C and Nvidia being extremely volatile and extremely downtrending in the recent terms. Now, when you put that as one of the aspects, what would you want to tell our partners about our risk management discipline?
Yeah. So let me make a broad comment, and then let me talk, for instance, about C in particular, just as an example. So there's a lot of layers of risk management. We obviously, because we run concentrated portfolios, we're not going to think about diversification by sheer number or region or exposures. But we do try to think about diversification and risk management in the context of correlation. We want to make sure that our positions, our businesses that we own are relatively uncorrelated. And so as a result of that, we do monitor on an ongoing basis. Every week, we get a report showing correlation trends across the entire portfolio, as well as by sector. We're looking at 60-day pairwise correlations and then summing those up to the portfolio level. And to the extent that correlations in a given sector move past about 0.5, 0.6, it starts to get a little warm for us, and it begs the question that we at least consider some temporary curbs on the types of companies that may be driving that correlation higher. So we won't exacerbate the problem further. That's happened a couple of times in our history, and we've taken steps so that the correlations gradually renormalize and start moving lower again as other things are added to the portfolio. We look on an ongoing basis at upside downside capture by name. We look at the bar global risk models at the underlying attribution of excess return. At the end of the day, the bulk of our excess return over time should and historically has come from stock specific risk. We want to make sure that things like factor exposures, currency, country considerations are not the drivers of excess return, positive or negative. And in most environments and over most time periods, stock specific is the biggest, and most of those other variables are relatively immaterial to the overall mix. So we monitor that. We look at every quarter, we get a large packet of information, really slicing and dicing the portfolio dramatically, not only looking at attribution and name by name contribution over different time periods, everything from the quarter to the 1 year to the 3 and the 5. But we also look at how things quintile down by earnings growth, by market cap, by ROIC, as indicative of what we may have embedded in the portfolio. So there's lots of different things that we look at and think about. when it comes to risk management. It's multifaceted. It looks over different time periods, both short and long. And it's reviewed, some of it's reviewed largely by myself and Mark. And then some of it gets reviewed by the larger team as well. So there's a pretty good set of eyes looking at this to ensure that we look and feel and continue to look and feel like we should as a growth portfolio. But at the same time, we have a really good understanding of what's happening, to results and what's driving results underneath the hood. In the case of C Limited, one other thing. So one thing in the risk management we do not have are hard and fast sale rules. So if a position drops, for example, 25%, I know there are some managers out there who will say that will trigger an automatic sale. We do not have that. In the early days of managing global portfolios, we tried some of those types of rules and found that we were ultimately selling positions after they dropped dramatically, pretty much at the bottom, because at the end of the day, in most of these periods of downdraft, very little had changed from a fundamental standpoint at the business, and the business continued to operate very well, and would go on to report very solid results, and investors would return to them, and they'd become market leaders once again. And so selling things down dramatically just because they're down didn't prove to be a particularly additive element to a risk management strategy when applied across the board. So as a result of that, something like C Limited, which has dropped from its peak pretty dramatically, is something that we obviously have spent a lot of time thinking about. We did trim after the most recent earnings report back during Q4, reflecting Q3. When some of that gaming revenue plateaued, we did trim the quote unquote top off the position and cut it back. But we did not go to zero, because at the end of the day, it still is the world's most downloaded game. It is generating about $3 billion of revenue for the company. And that a lot of that money is then being redeployed to help fund the growth in the e-commerce business. And they already are by far the leading e-commerce platform across non-China ASEAN. And they're starting to expand into Latin America, and they're looking at expansion into some of the European markets as well, with what has been a very successful business model across much of Asia. So a lot of opportunities still to come, in our opinion. Very, very solid gaming business that's not going away anytime soon. It just may not be growing as fast as it once was. And so we trimmed it. We cut it back a little bit. We took some of the risk off the table, but have kept the rest of the position. I mean, on a very short-term basis, do we wish we had trimmed back even more? I suppose. But we also could easily find ourselves over the course of 2022 in a situation where the company reports results that look really solid, that really look like nothing has particularly changed in an adverse way. And over time, that e-commerce platform will continue to grow and expand, and will be in a very, very powerful position with a good weight. The only other thing I would say there is that because it's come down as much as it has, its valuation today is actually looking very, very reasonable for the growth it offers. Like I said, would we have preferred to sidestep some of the downdraft? Sure. But from where we sit today, looking at the valuation, it doesn't look particularly expensive to us, given the earnings and cash flow prospects, looking forward. And it's that kind of analysis that we then apply, across the board in situations like that.
Sure, Tom. I think that was a very detailed perspective on the risk management, as well as specifically on how we manage individual stock positions. Wonderful. With that, we have come to the end of today's session. Thank you for your prepared remarks, as well as answering all the questions in detailed and transparent manner. Let me assure you on behalf of PGIM India that we will be hand-holding our partners as well as clients and making sure that the relevant information passes on to them on your behalf. Let me also remind our partners who are joining the call today that even after the recent divergence in performance, owing to whether we want to owe it to higher interest rate or the call towards higher interest rate, higher inflation, and so on and so forth, the 10 years or a decade long track record for the portfolio still gives you a 8.5% compounded return over and above the benchmark indices. While we have some other propositions in the landscape, which may be looking at specific geographies as well as sectors and themes, when you look at this in perspective, whether you look at it from an up capture, down capture ratio, whether you look at it from a batting average perspective, the fund scores very, very highly on all the aspects which I have mentioned. We'll be very happy as a team to circulate more and more information about the portfolio, and we'll be very happy to answer more queries. On that note, let me call it a day. And Tom and Doug, just in case you have any final comments, else we can close the call.
I would just say, Abhishek, thanks to you. You've been a great partner and the whole PGIM India staff, partner to us. But I also want to thank your clients for your confidence in us. We really are working very hard every day to drive this portfolio forward. As I said before, the next few weeks are going to be fascinating and very interesting to us as we get the next update from our companies. But we've lived through these environments in the past. We will live through this one, and we will come out the other side with some great businesses to invest in as well. So thank you very much for your time, though. Really appreciate it. And Doug and I certainly appreciate the ability to get in front of you and try to share our current views and some of the transparency on how we operate.
And I would just echo Tom's comments. And if there's any follow-up questions, comments that you folks need answers to, feel free to reach out. We're happy to address any questions that might not have been answered on the call today. But thank you very much.
Wonderful. Thank you. Thank you again. Thank you for everybody to make time today evening. And thank you, Tom and Doug, for doing it for our partners and audiences. Thank you. On that note, let's close the call. Have a good day.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.